Hi, welcome to this quick guide into the income statement. So what is the income statement? The income statement is also known as the profit and loss statement, and it's one of the four main financial statements. So we have the income statement, the focus of today's tutorial. There's the balance sheet, the cash flow statement, and the statement of changes in equity, and they're the four main financial statements. Specifically, the income statement is like a video of the organization's financial performance. It's like a video because it's a set of measurements across a set time or accounting period. For example, you can have an income statement from the 1st of January 2016 to the 31st of December 2016. And while the balance sheet, on the other hand, is a snapshot in time and represents one particular date, an income statement represents a length of time. The income statement will list income accounts, their respective totals, and an overall sum total, followed by expense accounts, their respective totals, and an overall sum total, and ends with a net income result, which is income minus expenses. Here's a quick simple example. You have income up the top, the accounts down the left-hand side, the figures down the right-hand side, expenses below that, some general expenses, and the amounts down the right-hand side, and net income down the bottom. So income represents a figure of 100,000, expenses total 70,000, and 100,000 minus 70,000 results in a net income figure of 30,000. So what is income that sits at the top of the statement? Here's the complicated accounting jargon definition. This is provided by the IASB conceptual framework and is the formal definition of income. Income is increases in economic benefits during the accounting period in the form of inflows or enhancements of assets or decreases of liabilities that result in an increase in equity, other than those relating to contributions from equity participants. But that's a very complicated definition. Here's a more simplified definition. It's receiving inflows of money that result in more assets or less liabilities that improve the net worth or equity of a business. Income reflects what the business sells. Income reflecting what the business sells is the most simplified definition. How is income broken down? Income is broken down into two major categories. There's revenue and gains. Now, revenue is income earned in the ordinary activities of an entity. In other words, it's doing what the business normally does. If you're in the widget sales business, then if you sell widgets, that's revenue. If you're a service business, perhaps an accounting service, so earning money through your accounting business would be revenue. On the flip side, gains are income earned that may or may not arise in the ordinary activities of the business. In other words, it's earning income through more abnormal activities. The example we have here is a book retailer selling a company car at a profit. So while selling the company car would be defined as income and would contribute to net profit at the end, selling company cars isn't the core operations of a book retailer. Now there are 5 criteria for revenue recognition. So when does revenue appear on the income statement? It must meet all of these 5 criteria. Firstly, the entity has transferred to the buyer the significant risks and rewards of ownership of the goods that it's selling. Secondly, the entity retains neither continual managerial involvement to the degree usually associated with ownership, nor effective control over the goods sold. As an example here, take McDonald's that sell Big Macs, hamburgers. Now, if I walked into McDonald's and purchased a Big Mac from the counter, at what point does the buyer, me, take the significant risks and rewards of ownership of the goods? This may be when the McDonald's worker hands me the Big Mac. From then on, I had the risks and rewards of ownership. If I drop the hamburger, that's a risk I have to face that I might lose my hamburger. Or if I eat the hamburger, I have the capability to enjoy those rewards of ownership. That's the first criteria. As for the second criteria, when does McDonald's lose managerial involvement over that Big Mac? When does it lose effective control over that particular hamburger that it sold me? At that point in time, it's the second criteria of revenue recognition. The third criteria is the amount of revenue must be reliably measured. So McDonald's, using the same example, would have to know how much I paid for the burger. Fourthly, it must be probable that the economic benefits associated with the transaction will flow to the entity. That is, McDonald's, the hamburger seller, must know that it's probable that it's going to receive the cash from the Big Mac sale. That's the fourth criteria. And finally, the fifth criteria, that the costs incurred or to be incurred in respect of the transaction can be measured reliably. That must mean McDonald's must know how much it costs to produce that hamburger that it later sold to me. It must know how much the patty cost, how much the bun cost, the special sauce cost. It must be able to reliably measure those costs that go into the income generating Big Mac. Once all of these 5 criteria are met, and it must be all 5, then revenue can be recognized, which will later appear on the income statement. Now, when it comes to McDonald's and Big Mac sales, this is a pretty simple and straightforward transaction. The revenue recognition principles are pretty black and white. But you'll find in many businesses, their transactions are far more complex, and there's a lot of grey area about when revenue should be recognized. That's why there are these 5 strict criteria. Okay, so we've covered income. Now we'll move on to expenses. And we're going to use another complicated accounting jargon definition and then move on to a simplified definition. But before I talk about this, just try to remember back to that complicated accounting jargon definition of income. As I read this, look how close these 2 definitions are. You'll see that the IASB conceptual framework definition of expenses is basically a mirror image of income. So here we go. Expenses are decreases in economic benefits during the accounting period in the form of outflows or depletions of assets or incurrences of liabilities that result in a decrease in equity, other than those relating to distributions to equity participants. See how similar they were? But it was the reverse. And here's the simplified definitions. The outflows of money that result in less assets or more liabilities that lower the net worth or equity of the business. Essentially, these are the costs incurred in operating the business that generate income. They are the opposite of income. Once again, expenses are broken down into 2 major categories. These are expenses and losses. Sorry that expenses are broken down into 2 categories, being expenses. There's a duplication of the word expenses, but hopefully the following couple of slides will explain it. Now, expenses are expenses that are incurred in the ordinary activities of the entity. So this is like salaries or rent. Paying your staff or paying for the office rent is an ordinary activity of the entity. And losses, similar to gains, which we talked about earlier, are expenses incurred which may or may not arise in the ordinary activity of the entity. So these are the more abnormal expenses. And these may be impairments or foreign currency losses, for FX losses. Now, when are expenses recognized? Expenses are matched using the matching principle. And the matching principle is one of the core concepts of accounting. The matching principle states that expenses should be recognized in the same accounting period as the revenue that the expenses, generate. They should be matched against the income that they generate. This is based on the idea that any business will only incur expenses on the premise that it will earn income from these particular expenses. Using our McDonald's example again, in application, this would mean that when McDonald's recognize the expense of the patty, or the expense of the bun, or the expense of the sauce, or the expense of the staff member that served me, they should recognize those particular expenses in the same accounting period that I purchased my Big Mac. They should all line up. This matching principle allows a better measurement of profit. And remember that profit equals income minus expenses, and our goal is to have an accurate measure of profit. So if we line up the income and expenses that are related to each other in the same accounting period, then we will have a more accurate profit figure. We can truly see whether these particular business expenses are generating a profit based on how much income we earn from those expenses. The matching principle is a mix of accrual accounting and revenue recognition principles. Okay, so we've talked about income, we've talked about expenses, now let's talk about net income. Net income is the result of the previous two subjects. Net income is income minus expenses. Net income is also known as profit or net profit or simply earnings. You'll often hear it referred to as the bottom line. This is because it sits on the very bottom line of an income statement. It's also, net income is a very important figure, and that's often why you hear people refer to as the bottom line of a particular situation being a very important outcome of that particular situation. This is because net income is often the ultimate goal of a business. It is the bottom line. Now, when expenses are greater than income, then it's referred to as a loss or a net loss. But what does net income represent? Well, profit or net income is a performance indicator representing the outcome of achieving the profit motive. Now, in an old-fashioned, neoclassical, black and white world that the only reason businesses exist is to achieve a profit, the net income figure is the indicator of how well it achieves that particular profit motive. But a more accurate representation of what net income is, it is that it represents a betterment of a business's position over the period through either financial capital, being net assets, or physical capital, being the productive capacity, excluding the distributions and contributions from the owners. So over a period, if net assets have increased, that's a betterment of a business's position. It's got more assets. Or if the productive capacity has increased through an increase in the physical capital, then this is also a betterment of a business's position. And both of these outcomes, whether financial capital betterment or physical capital betterment, is a result of profit over the period. So here's a review. The income statement is like a video across a period of time of the financial performance of a business. It lists income, followed by expenses, which results in net income or profit or a net loss or a loss. And never forget, income minus expenses equals net income. That's it. Thanks very much for your time. That is a quick guide to the income statement. I hope you can give me a thumbs up if you enjoyed and got value from this tutorial. Cheers.